Treasury yields remain stubbornly low. Yes, despite the fact that we saw them uptick today on the optimism of the U.S. and China, and the stock market echoed that much more loudly than the bond market as stocks made back a chunk of what they lost yesterday. Bond market didn't seem so appeased by what was happening between the U.S. and China. And while we did see 10-year note yields creep up, it really settled only up 2 basis points on the day. And I think that for the most part, that has been the real story here, is that yields are stubbornly low. They're not being overreactive to what we're hearing in the news. And you continue to see them just slightly continue to tick lower on a day-by-day basis with a few upticks here and there. If you go back to April when we saw that 2.6 yield print, it's really been nothing but a steady trade lower. We didn't see many gaps. We didn't see many one day, down 5-6 basis points and rally 10 basis points. It's been a steady trade lower. Something that I think is not been really written about. It's kind of gone under the radar here as stocks take center stage. And yesterday we saw gold with a big bid, and the stocks, they go up, they go down, they go down, they go up. The bond market's just been steadily continuing to see prices rise and yields decline in an environment where we're seeing economic coming off the heels of a rate hike in December and what was perceived to be much more greater economic expansion. And I think that right now that is something that will be a thorn in the side of the Fed moving forward. And I expect that yields, while they remain stubbornly low, are going to continue to do that for quite some time, especially if the global economy can't get its sea legs back under it. And if you look at market volatility, the one index that we continue to look at is the VIX index, and yes, that's a reflection of stock volatility, but sort of gives the pulse of the market. And yeah, that was back down below 20 today, certainly elevated from what we're used to levels. And bond volatility is the same. We see Treasury volatility hovering around 4% in the 10-year bucket. It's down around about 380. Yeah, that doesn't seem like a much, but it's elevated because what we were seeing was low threes. And I think at this point, volatility on the upswing, or at least maintaining a bid, suggests that uncertainty remains on the forefront, and a break outside of the range, or at least not following the trend, is something to expect. So right now, volatility, while lower off the highs, remains elevated. Yields remain stubbornly low. What can the Fed do? Well, we heard from Esther George today, Kansas City Fed president. She says that it's not necessary to reduce rates or cut rates or do anything with rates at this point. And that's kind of the echoing we've been hearing from them, whether you're talking about Richard Clarida, Mr. Powell himself, or any of the other presidents and governors. They basically want to tell you what the Fed doesn't have to do. And right now, if you look at the market, it's clearly priced for a rate hike by the end of this year. A lot of that expectation came in the short term after what we saw happen with China and the potential ripple effects of growth in the U.S. But I think ultimately, the market will continue to tell you one thing, and the Fed will continue to tell you what they want to do. And of course, you have to have your wants and your needs. Well, the Fed doesn't want to cut rates, but they may need to cut rates at some point if the economy starts to stumble. And I think we're starting to see rumblings of that. And the market, while it could change, it could make a big shift here if some big dramatic move happens or something out of left field. But ultimately, the market is going to continue to do what the market does, and the Fed will try and dance around it until the two merge. And typically, the Fed will have to merge with the market expectations. Again, unless something happens. We get some really great numbers in the second and third quarters, allows the market to take a deep breath, and they take out that cut. But right now, you are sitting on 25 basis point cut by the end of the year, likely to come in the third or fourth quarter of this year. And that may be why we're seeing the yields that we're seeing today. We see 2-year note yields on their year-to-date low. We see 10-year note yields near their year-to-date low. We see 30-year yields, all of them just very low historically, and given the fact that we just saw rates go up not more than 5 months ago. So as we head into the middle of the week, it looks to me like we're going to see continuation of lower 10-year note yields, higher volatility, and more uncertainty.